Moody's downgraded the United States' perfect credit rating on Friday for the first time in more than a century over the nation's growing $36 trillion debt pile.
The ratings agency Moody's just stripped the United States of its perfect AAA credit rating, dropping it to AA1. This is the first time in history that all three major credit agencies, Moody's, S&P, and Fitch, have downgraded the US from their top-tier rating. Why does this matter? How will it affect your investments, your loans, and the broader economy? We're diving deep into what this downgrade means for you, why it happened, and what you can do about it. So hit that like button. Let's do it. Welcome back. My name is Steven Spicer, and I remember helping clients navigate the chaos that ensued after the first ratings agency downgraded the US. That was 14 years ago, and our economic situation has only gotten worse. Luckily, the solutions I found to help mitigate this type of chaos have improved since that time, so that's at least some good news. Anyway, here's the breakdown. In mid-May, Moody's Ratings announced it was downgrading the US government's credit rating from AAA to AA1, citing a ballooning national debt and rising interest costs that outpace other top-rated countries. This move follows S&P's downgrade in 2011, that one I was referencing earlier, and Fitch's in 2023, meaning the US no longer holds a perfect credit score from any major agency, a historic shift. The Wall Street Journal reported that this downgrade reflects growing concerns about America's fiscal health, with the national debt hitting $36.2 trillion and deficits projected to climb from 6.4% of GDP in 2024 to nearly 9% by 2035. But what's driving this downgrade, and why should you care? Let's break it down. Moody's decision hinges on two major issues: soaring government debt and political gridlock. The US debt to GDP ratio has surged over the past decade, driven by large fiscal deficits and rising interest payments. I break that all down for you in an amazingly acted video right here. Check it out, let me know what you think. Moody's noted that interest costs are now significantly higher than those of other AA1 rated countries like Germany or Canada. For context, the Congressional Budget Office projects that net interest payments on US debt will hit $1 trillion annually by 2030, eating up a huge chunk of the federal budget. Political dysfunction is another culprit. Moody's pointed to repeated failures by successive administrations to control deficits, exacerbated by partisan battles over the debt ceiling and tax policies. For example, President Trump's push to extend the 2017 Tax Cuts and Jobs Act could add $4 trillion to the deficit over the next decade, according to Moody's. A recent setback in Congress, where hardline Republicans blocked a sweeping tax bill in May, underscores the gridlock. This instability raises doubts about the U.S.'s ability to manage its finances, even as it remains a global economic powerhouse for now.
We are writing checks we cannot cash, and our children are going to pay the price.
Despite the downgrade, Moody's assigned a stable outlook, citing the U.S.'s strengths: a dynamic economy, the dollar's global dominance, and an independent Federal Reserve. But as we've been exploring here on this channel, with Trump questioning the Fed's autonomy and a debt ceiling deadline looming this summer and other global and economic issues that we have, threats to even those current strengths are mounting. Needless to say, the downgrade rattled markets, though the reaction was less severe than you might think. It was less severe than it was in 2011 when S&P made that initial move. Anyway, on the day of that announcement, the S&P 500 edged up 0.1% after an initial 1% drop. Treasury yields climbed, with the 10-year note hitting 4.449% and the 30-year bond topping 5% per Reuters. Higher yields reflect investor concerns about lending to the US government as they demand more return for perceived risk. This could increase borrowing costs across the board, from mortgages to corporate bonds. But how does this affect you? What does this mean for your wallet? A US credit downgrade can ripple through the economy in several ways. One, higher borrowing costs. Treasury yields influence consumer loans, with 30-year mortgage rates already tied to the 10-year Treasury could rise further, making home ownership pricier. Credit card and auto loan rates may also creep up. 2. Inflation pressures. Federal Reserve Chair Jerome Powell warned in May that tariffs and fiscal deficits could keep inflation above 3% in 2025, delaying rate cuts. This squeezes households already grappling with higher prices for goods like groceries and gas. And 3, market volatility. While markets stabilized quickly this time around, Max Gochman from Franklin Templeton warned of a potential bear steepener spiral, where rising yields and a weaker dollar could dampen U.S. equity appeal. For example, Walmart recently announced price hikes on items like bananas and electronics due to Trump's tariffs, which compound the downgrade's effect. We'll dive more into exactly what the world's largest retailer is doing and how that impacts you in a second. But yeah, a CNBC supply chain survey from April 2025 found that 63% of respondents expect a recession in 2025, partly due to these combined pressures. But it's important to keep an eye on the bigger picture. The downgrade doesn't exist in a vacuum. Trump's tariff policies, 145% on Chinese goods, later reduced to 30%, 10% on Canada and Mexico, 25% on steel and autos, and so on, are adding fuel to the fire. These tariffs, aimed at boosting U.S. manufacturing, have led to higher consumer prices and economic uncertainty. To be clear, this is not me expressing a political opinion on tariffs specifically. All this tariff business may achieve Trump's aims in the long run. I don't know, and that's not the point. The point is the potential for chaos and doing what you can to make sure you are as protected as possible, no matter the ultimate outcome, no matter how extreme the volatility along the way. That's what our Financial Doomsday Survival Guide prepares you for example. But anyway, the point is there is obviously economic uncertainty right now. The U.S. economy contracted in Q1 2025. Businesses rushed to import goods before tariffs hit, which disrupted supply chains. Moody's warned that these policies, combined with tax cuts, could balloon deficits further, risking long-term fiscal stability. On the flip side, some argue tariffs could spark a U.S. manufacturing renaissance. Trump claimed that his policies would lead to an economic boom, but some economists are skeptical, noting that higher costs and inflation often outweigh short-term gains, aligning with those concerns that Moody's expressed. For investors, this downgrade should be a wake-up call. Make sure you're prepared for the reality of the United States' precarious and unprecedented financial situation. Helping clients understand that reality is what led to my book, Stop Investing Like They Tell You. I think the reason that it hit #1 on Wall Street Journal's bestseller list is because deep down, people know there's a problem. Jay Hatfield from Infrastructure Capital Advisors called the downgrade a wake-up call for Republicans to address deficits, suggesting markets may push for fiscal discipline. However, with Trump's One Big Beautiful Bill Act proposing deeper tax cuts, I wouldn't hold your breath for austerity. Moody's downgrade is a historic moment, signaling that even the U.S. isn't immune to fiscal scrutiny. It's highlighting something I point to in my book. The variables today are very different than they were in the past. And just like with any science experiment, when you have significantly different variables, you wouldn't necessarily expect the same results in the future. Yet that's what most financial advisors and online experts are telling you to do. The market will just continue to go up like it always has because, well, it always has. That's bad logic. The variables are different. You can and should plan accordingly. While the immediate market impact has been muted, the long-term risks, higher borrowing costs, inflation, and volatility could hit your wallet and portfolio if deficits keep growing. It's our goal at Spicer Capital to help you navigate these turbulent times. So what do you think? Will this downgrade force Washington to get its fiscal house in order, or are we headed for more economic turbulence? Drop your thoughts in the comments and I'll meet you there. And as far as what you can expect Walmart to do, as I mentioned earlier, and how it will affect you, whether you shop there or not, I guide you through all that in this one. I'll see you there.